Hey, what's up everyone? This is Wesley with Debt Free with Wesley and Slat Financial. I hope everyone's doing great as you're watching this video. I want to say thank you in advance for taking the time out of your day and your busy schedule and your busy lives for watching this video, investing into yourself and your education, and improving your financial situation. Today I'm going to do an example for you of a velocity banking scenario using a $10,000 debt that we're going to pay down using a credit card balance transfer offer. So I currently have two offers from Discover right now. The first one is a 0% interest APR for 12 months and a 4% transfer fee. And the other option is a 5.99% APR for 15 months and a 0% fee. And I'm just going to illustrate in Google Sheets how these numbers actually play out and why it's really important to go below the surface and really calculate the math on these scenarios so that you're not being tricked or misled by sexy marketing. Alright, so just as a disclaimer, 9 out of 10 people are going to look at this lower rate option and as a knee-jerk reaction select it because they see that 0% interest. Okay, and I'm going to show you why that's not necessarily the best way to go in terms of your finances and in terms of paying the least amount in interest and fees to the banks and recapturing that money for yourself and your family and your own financial situation. So let's look at these in a velocity banking scenario. Again, if you're not familiar with velocity banking, it's using credit cards, personal lines of credit, and home equity lines of credit to rapidly pay down debt by depositing 100% of our income into those credit lines at the time of receiving the income, and then drawing our expenses out of those credit lines gradually as our expenses come due throughout the course of the month. And what this does is it keeps our debt balances as low as possible for as long as possible, and therefore there's less balance for interest to accumulate on, and so we pay off the balances much faster, and we also pay significantly less interest. In some cases where people are using velocity banking to pay off their homes, they're saving decades of time and hundreds of thousands of dollars in interest payments. So this is a pretty small example. We're just going to use an example of a $10,000 debt, and we're assuming an income of $4,500 with expenses of $3,000 per month and a monthly cash flow of $1,500. So this first example is the 0% introductory offer. So 0%, 12 months with a 4% transfer fee. So the key thing to remember with these transfer fees, okay, unlike an APR or an annual percentage rate, a transfer fee charges that full 4% onto the balance immediately upon transfer. So if we take 4% of $10,000, that's $400 that gets added to the balance immediately upon transfer. Okay, so right off the bat, our $10,000 jumps up to $10,400. Okay, so our starting balance is $10,400. We're then going to deposit all of our income for the month into that into the credit card. Okay, this also assumes obviously that we don't have any expenses that have to be paid in cash, right? It's assuming that all of our expenses can be paid on the credit card. Okay, we're going to deposit all that income, and then we're going to draw our expenses back out throughout the course of the month, and then our end of month balance is going to be $8,900. Okay, we're not paying any interest because, of course, there's 0% interest for 12 months. Okay, we're going to rinse, wash, and repeat this process, and as a result, we're going to pay that entire $10,000 balance off in about seven months. Okay, month 7, this balance will be paid off in full, and our total costs. Okay, there wasn't any interest, but our total cost is $400 for that fee. Okay, 0 interest, but a 4% fee, which costs us $400. Okay, so the second example is a 5.99% interest rate for 15 months and a 0% fee. Obviously, 5.99 is higher. A 5.99 rate is higher than a 4% fee, but again, the 5.99 is an annual percentage rate. And what that means is if I let this $10,000 balance sit unpaid for 12 months, it would accumulate 5.99% interest over the course of 1 year. But I'm not going to let it sit for 12 months. We're going to velocity bank that balance and keep the average daily balance as low as possible for as long as possible, which is going to pay this off a lot faster. So you can see in the example here that after the first month, that balance has been driven down from $10K down to $8,500, and the interest on that is $49.92. Okay, now that number will end up being lower than that, but just for the simplicity of this example, we're just going to assume that the $10,000 balance stayed on the account for the majority of the month. Okay, when we play this scenario out over the course of 8 months, you'll see that the balance pays off at the same time as the previous example, but our interest cost over the course of those 8 months is only $196.14. So even though this rate is higher than that fee, okay, because of the way it's calculated, it's a lot less money. Alright, so this is just an example to help everyone understand how some of these offers aren't necessarily as clear-cut as they seem. In most cases, going with the longer duration with the rate is going to pay off much better than to pay that fee with the 0%. Alright, so hopefully this was helpful for you. If you have any questions or feedback, definitely let me know, and we'll see you in the next one.